Welcome to GRE. I'm your host, Keith Weinhold, talking about how most home building materials are U.S. sourced and not affected by tariffs, the little understood pros and cons of investing in apartment buildings versus single-family rental homes, then what really makes sense to invest in this particular era, and more, today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Tallahassee, Florida to Waxahachie, Texas, and across 188 nations worldwide. I'm Keith Weinhold, and you are inside GRE. We are here for you every Monday without fail, 52 weeks a year, and we have never replayed an old episode either. Always original content. Thanks for being here, but you're not here for me. You are here for you. As another year dawns, before we get into the meaty real estate content of today's show, including single-family rentals versus apartments, take a moment to check in with your own goals. Maybe you think about that as just buying your first investment property, or maybe you own 83 rental units and you're looking to get to 100 this year. But no matter, really, real estate is just the fuel for your goal. It's probably not the end goal itself. Is your goal to have the time freedom to watch all of your kids' basketball games this year? What about beyond this year? Are you really dreaming big enough? You've got to question yourself on that sometimes. For example, forget flying first class. What if you want to own your own private jet, like Taylor Swift's luxurious Dassault 7X jet for $54 million? How about real estate fueling a dream that's even bigger than that yet? Last month, the Philadelphia Eagles received NFL approval for the sale of an 8% interest of the team to two different family investors. Okay, do you find, say, that interesting? Owning part of a major pro sports team. And by the way, what would something like that look like for you? I mean, do you even have the headspace to conceive of such a thing? It's good to ask yourself questions like this sometimes. That sale was based on a valuation of the team of up to $8.3 billion. And yet, after all that, the Eagles owner, Jeffrey Lurie, he still maintains complete control of the team. Okay, so if each of the two family investors got a 4% interest, at this valuation, that is up to a $332 million investment for each family. Maybe that could be a Weinhold family goal. We'll see about that one. And, you know, when it comes to making yourself a bigger you and dreaming a bigger dream, I like to listen to what the doers say. I found it so interesting. In a Jeff Bezos interview at the Deal Book Summit, Bezos said it's human nature to overestimate risk and underestimate opportunity. Bezos also said entrepreneurs would be well advised to try and bias against that piece of human nature. The risks are probably not as big as you perceive, and the opportunities may be bigger than you perceive. That's the end of what Bezos said, and I really think that that's spot on stuff. Now, 2 weeks ago, when I gave GRE's National Home Price Appreciation forecast for this year, you might remember that I said that potential Trump tariffs just don't matter as much as people think when it comes to real estate. And understanding more about why I say this, it can help you understand real estate materials and sourcing and home building in the United States. America's overwhelming majority of sourced building materials are not imported. So therefore, something like a supply chain bottleneck, that's more worth watching. Really, it's a huge misunderstanding of the home building market to assume that most building materials come from overseas. They do not. Not even 10% of residential construction building materials are imported. The National Association of Home Builders will tell you so. And really, the majority of those few imports that do come from elsewhere, they come from Canada in the form of timber. You might have heard about that before. Now, there are some things like finishes and fixtures that get sourced from, various other countries. But yeah, the biggest potential tariff expense impacting home builders would come from enacting a cost on Canadian lumber. But I, and a lot of economists as well, they're pretty skeptical that the administration would really enact a tariff on a close ally like that, on Canada's raw materials. In fact, Chief Economist Lawrence Yun of the NAR, he conceded that even potential lumber tariffs, they might be given a phasing-in period, and that would encourage American timber mills to fill in any production gap. It's also important to, remember that doors, windows, cabinets that builders utilize, they are typically produced within U.S. borders. Windows, doors, cabinets made domestically. Unless it's something that relies on raw materials that are imported, they ought to be little affected by tariffs. One example is that kitchen sinks. Now, they largely went from being sourced in China, then Malaysia, then Indonesia, and one main customer is now talking about sourcing them out of Mexico or the Dominican Republic. So there are a few things, that less than 10% that's imported. Another imported item is flooring, which moved away from China, went to India for a while, went a little bit back to Brazil, and now more is being sourced by Ecuador. But the important thing to remember is that these are outlier components. Not even 10% of residential construction building materials are imported. That's what you want to remember. Concrete, U.S. Rebar, U.S. So, as a real estate investor, you can feel good that as your portfolio grows, each one of your properties was chiefly built with U.S. labor, that you already knew, but it is also built predominantly with U.S. materials as well. How likely are single-family rental investors to say that they want to buy more investment property this year? Well, a year ago, 60% of them said that. Today, it is up to 76%. Yes, that many say that they are either likely or very likely to buy single-family rental property in the next 12 months. And that same group that was surveyed is also unlikely to sell their property. And they also said that they are more likely to raise the single-family rent this year. And all this is according to a joint Lending One Resi Club survey. However, most fall in the range of raising the rent between just 1% and 6% this year. So pretty modest rent increases. In fact, in every region of the U.S., the majority of single-family rental investors describe their rental market as either strong or very strong. But can you guess the weakest region? Okay, this region, it's the one that still has a majority of landlords that say that their market is strong, but yet the weakest of them all is the Southwest. And that is largely due to overbuilding. And in the survey, what expense increased the most the past 12 months? Well, number one is that 37% of respondents, these landlords, said it is still insurance premiums. Second place was that 23% say property taxes are increasing the most. And then third was 21% say that maintenance and repair costs have increased the most for them. So the top three expenses cited, expense increases that is, in order are insurance, property tax, and then maintenance and repairs. And a few weeks ago, I discussed with you, you might remember, about how upgrading or remodeling a unit, that helps you in at least 5 different ways simultaneously. Let me talk about this since I touched on raising the rent and a little comprehension test here. Do you remember what those 5 ways are? The 5 ways you're helped by upgrading or remodeling a unit. And no, these are not the famed Real Estate Pays 5 ways. When you upgrade a vacant unit for rent, or at times you can even actually upgrade a unit while the tenant is still occupying the property, if it's not a disruptive upgrade type, okay? I mean, sometimes that tenant can be appreciative that they're getting an upgrade while they live there. But the 5 ways that upgrading a unit helps you are first, well, obviously it helps you be able to get more rent and cash flow. Secondly, you tend to attract a higher quality tenant. And then in a 5+ unit apartment building, it also increases your NOI, therefore a greater overall property value. Fourth is pride of ownership. And then fifth is that higher rents help you offset those erstwhile higher operating expenses. And here's the thing. When you get free help from one of our GRE investment coaches, like you can do at gremarketplace.com, those properties are either already extensively renovated or they are completely brand new build. So because of that fact, this means that from day one, your rent income is already optimized. You already have the best chance of landing a quality tenant, and you get some sense of having a pride of ownership. And all of those things, they're already optimized for you. You don't have to tinker with anything else. Because those GRE Marketplace properties, more than 95% of them are either renovated or new build. I would say using properties conducive to the BRRRR method, they would be the few exceptions there. And on GRE Marketplace, you can find lower cost renovated single-family homes up to $1 million apartment buildings, either new or renovated. And another pro tip here to help you with something actionable and a premium place to source your growing income property portfolio, you've heard me mention them before, is Mid-South home buyers. But I'll tell you more about what's going on with them. Yeah, they're an especially good place to add to your portfolio if you either haven't invested outside of your home market before, or you don't have as much liquidity right now, because their prices are just 100 to 180K. They are still in that range. And yes, that 100 to 180K, that is indeed the entire capital price for the asset. So that means down payment and closing costs being about 25%. Therefore, it's just 25K to 45K. Yes, you can still get started for that little with a wonderfully renovated property in either Memphis or Little Rock. Those are the 2 markets where Mid-South Homebuyers operates. And they are some of the most investor advantaged markets in the entire nation. And then the U.S. is one of the most investor advantaged markets in the world. And last month, I met and spoke with a 19-year-old guy that lives in Dallas, and he just bought his first ever investment property from Mid-South Homebuyers in Memphis. And in fact, it was his goal to have his first income-producing property at age 18, and he bought it the day before he turned 19. So he barely met that goal. But yeah, they are total pros at Mid-South. They've been doing it for over 2 decades. They say that they are the nation's highest rated turnkey property provider. They might even be the first provider in the nation. And if you like, they also manage the property for you. And the property managers are really aware that their investors, like you, seek a return on investment. So they often have a waiting list to get their properties. Last I checked, the line at Mid-South had shortened, globally attractive cash flows, an A-plus rating with the Better Business Bureau, and they've now renovated over 5,000 houses. And over there, they do a lot of things with their management that you just wish every provider would do. There is zero markup on maintenance. Their average occupancy rate is almost 99%. Average renter stays more than 3.5 years. And, that 3.5 years, that duration of tenancy, that could be poised to go even higher now with the affordability crisis for these wannabe first-time homebuyers. Now, most of what Mid-South has are single-family rentals, quite a few duplexes too. Every home has brand new components, a full 1-year warranty bumper to bumper, new 30-year roofs, and then the really important part, expect a high-quality renter that they screen and find and place for you. So let me give you an example of 2 real properties. And now, if these 2 aren't under contract already, they probably soon will be since I'm mentioning them. And of course, duplexes cost more than single-family rentals. This duplex is in Jacksonville, Arkansas. It's just northeast of Little Rock. It is 913 and 915 Ruth Ann Drive. The combined rent from both sides is $1,775. The all-in cost is about $210K, $2,099. In total, it's 1,600 square feet, so 800 square feet each side. It's 2-bed, 1-bath each side. The property taxes are really low, $1,300 a year. Really nicely renovated with good quality materials. I mean, I love owning properties like this all day. So that's a duplex in the Little Rock market. Another one for Mid-South is this Memphis single-family rental. The address is 400 Bonita Drive. It is $1,200 rent on a $148,100 purchase price. Gosh, those numbers work. This single-family rental is 3-bed, 1.5-bath. 1,164 square feet. Gosh, again, low property tax in these regions, just $1,120 annually. All right, so that property tax rate is just 0.75% of the purchase price, so really low on a national basis. A big backyard, eat-in kitchen, separate laundry room, walking distance to schools. I mean, this is the type of property a tenant family could live in for 5 or 10 years. Beautifully renovated, and I'm bringing these up because these are all at prices that Metro New Yorkers or coastal Californians can barely believe. So each property has hundreds of dollars of projected positive monthly cash flow. Each one increases your income $2,000 to $5,000 per year. And I have personally toured Mid-South Homebuyers' office in Memphis and their properties in person in Memphis. And I've seen their properties in each stage. I walked a teardown that they were doing, and I saw all the debris in the backyard. And I have seen their hardwood floors shine inside newly renovated property that I walked with both Terry and Liz from over there at Mid-South. She is a pretty popular and extremely knowledgeable woman there, Liz. You can ask for her or one of her team members about getting on the list over there. Yes, these are $100K to $180K already renovated. Yes, that's truly the all-in price. And they are in decent, working-class, pride of ownership neighborhoods in Memphis, Tennessee, and Little Rock, Arkansas. And a lot of people get their start in investing there. I suspect it's now in the hundreds with the number of GRE listeners that have bought from them. But even veteran investors with dozens of units, they scoop up properties from them. Due to the low prices, some even pay, gasp, all cash. Yes, no leverage for them. And Mid-South Homebuyers has Investor Tours Monthly, where they load everyone on a bus and you can check out the properties because they are really proud of what they offer there. Coming up next, I'm comparing single-family rental investments to apartments. But yeah, right there, that was a pro tip that really ought to help you out. Expect cash flow from day one. A 19-year-old is doing it. You can start yourself at midsouthhomebuyers.com. More next. I'm Keith Weinhold. You're listening to Get Rich Education. Oh, geez. The national average bank account pays less than 1% on your savings, so your bank is getting rich off of you. You've got to earn way more, or else you're losing your hard-earned cash to inflation. Let the Liquidity Fund help you put your money to work with minimum risk. Your cash generates up to a 10% return and compounds year in and year out instead of earning less than 1% in your bank account. The minimum investment is just $25K. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And you know how I know? Because I'm an investor in this myself. Earn 10% like me and GRE listeners are. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866. Hey, you can get your mortgage loans at the same place where I get mine, at Ridge Lending Group, NMLS 42056. They've provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back. For the 535th week in a row, you are listening to Get Rich Education. I'm your host, Keith Weinhold, and I'm really grateful to have you here. If you self-manage your properties, one software that can really simplify your life is called Hemlane. H-E-M as in Mary, L-A-N-E, Hemlane. You might have heard about it before. I now know quite a few people that use it. It's been getting some really good reviews. You can manage your properties from anywhere, even through your phone, and Hemlane's got some really good integrations. And now it's more than just investors like you that are using it. Agents and property managers are using Hemlane too, from advertising to tenant screening to maintenance and repair and accounting. And I just learned that they recently got all of the state-specific lease agreements integrated on their platform as well. That's why it was on top of mind. If you prefer to self-manage and you want to make it easier, what you can do is book a free demo, and they show you how it works over there. It's just hemlane.com where you can do that. If you like, let them know that I told you about it. Before I share something else actionable with you, let's do some learning and talk about apartment buildings and single-family rental properties and compare the two, some pros and cons of each. And perhaps the most obvious advantage of apartment buildings is their economies of scale. A 12-unit apartment only has one roof to maintain and one insurance policy to maintain. Another efficiency is that shared common areas and plumbing and HVAC systems that can lower your individual maintenance costs on a per-unit basis as well in those apartments. And right now, at this time, in the mid-2020s decade, another advantage of apartments is that this time in the cycle is where values are just about bottoming out. Apartment buildings in a lot of national regions have fallen 20%, fallen 25%, or even fallen 30% or more from their highs that were seen 2 to 3 years ago, and that's due to those higher interest rates. And the reason that this is an advantage for apartments is that you might be able to buy low, buy the dip. Apartment cap rates have settled in the mid-5 range now. Well-located Class A has dropped back into the 4s. Longtime investors already know about some of the advantages, but even some longtime investors, they often overlook some of the advantages that single-family rental properties have over apartments. So let me share some of those with you. Now, as you know, I started off with my first 2 investment properties, both being fourplex buildings. And then after that, I added larger apartment buildings and single-family rental properties. And I still do buy and own single-family rentals. So let me tell you about why I love them. They might have the best risk-adjusted return anywhere. Even after 2008's Great Recession, those that bought single families for cash flow persevered. With single families, you get a better quality of tenant than you do in apartments. They take care of the premises. They tend to be in a better neighborhood. Single families tend to appreciate better over time, and they're also more likely to be in a better school district. Single families have a retention advantage. Tenants stay longer, and that creates less vacancy and expense. And the reason that they do stay longer are those aforementioned neighborhood and school district characteristics. Common areas, single-family rentals, they don't have any common areas that you have to clean and maintain. I think I pointed that out to you before because that's like an overlooked profit drag that I missed when I bought my first larger apartment building. Yeah, apartments have hallways and stairs and laundry rooms and common outdoor grounds that a custodian has got to service. Single families have an advantage when it comes to utility payments because tenants often pay all of the utilities and they even care for the lawn. The larger the apartment building is, the more likely that you are going to be the one paying the utility costs. Then there's divisibility. What if you've got a property that's underperforming out there and it just isn't meeting your expectations? Well, if you had, say, 10 single-family rental homes, you can sell off the 1 or the 2 that aren't performing, but yet with a 10-unit apartment building, you've either got to keep them all or sell them all. It is not divisible. What about fire and pestilence? Something a lot of people don't talk about. Fire and pests, they're more easily controlled in single-family rentals. Even if you're adequately insured, these conditions often affect multiple units and families. They can spread in an apartment building. Financing is a huge one. Income single-family homes, they have both lower mortgage interest rates than apartments and typically lower down payment requirements than apartments. I think you already know you can secure 10 single-family rental loans single, 20 if you're married, at the best rates and terms through Fannie Mae and Freddie Mac with just 20% down payments. You can even go less than 20% on non-owner occupied in some cases. But apartments rarely, if ever, have 30-year fixed-rate terms like single-family rentals do. And this right here in particular, that really started bringing down a lot of apartment investors beginning in 2022 and 2023 when their interest rates reset much higher, doubling or even more than doubling. How about vacancy rate? It is true that if your single family is vacant, then your vacancy rate's 100%. If your, say, fourplex has 1 vacancy, well, then your vacancy rate's only 25%. But yeah, the same is true if you own 4 single-family rentals and 1 is vacant. How about management? If you hire professional management, your manager would likely rather deal with higher quality single-family residents. And if you're self-managing, this is a demographic of people that you would likely rather handle yourself. Then there's supply and demand. There just absolutely still are not enough low-cost single families that make the best rentals. Nationally, demand still exceeds supply. That's the opposite condition for apartments. And this is something that's going to continue in the short and the medium term. Market risk. that is an overlooked criterion. You've got to keep your properties filled with rent-paying tenants that have jobs. If you think you'll be able to buy 10 rental units in the near future, well, your 10-unit apartment building, that's only going to be in one location, and that's going to leave you exposed to just one geography's economic fortunes. But if you have 10 single families, you could have 4 of them in Central Florida, 3 of them in Fort Worth, Texas, and 3 of them in Memphis. Then you got to think about exit strategy. A lot of people don't think about this. Think about the exit before you even get in, because years down the road, when it's time to sell your income property, hopefully after you've had years of handsome profits and real estate pays 5 ways and all of that, you know what? Down the road, there is going to be a greater buyer pool for your single-family rental than your apartment building in almost every case. More buyers can afford the lower price. And unlike apartments, you even have access to a pool of buyers that might want to occupy the single-family rental themselves. It might even be your current tenant that buys it. But the market and the numbers have to make sense for someone to want to buy an apartment building. But if an owner-occupant buys it from you, that family doesn't have to have any numbers that make sense. So your single-family rental is more liquid on your exit. And professional management, that's another reason that single families can make sense, because, see, single family rentals, they can be spread all over a metro area diffusely. And if you self-manage, that is a lot of little trips. That can get to be a hassle. But if you use a pro manager, well, they're the ones that have to manage the scattered sites. And a lot of times, managers don't charge you much more to handle your single families than they do your apartment buildings. So right there were a ton of advantages, a good 15 or 20 advantages there that single family rentals have over apartment buildings. And it's important I discuss them because there are a lot of investors that don't factor all of those in. Even veteran investors tend to overlook some of those things. Again, I really like apartment buildings as well. They could very well be my second favorite investment to single-family rentals. And I would like to now, with that understanding, really say something that I probably don't say quite often enough. If you want to benefit from all these wealth-building forces here that I've talked to you on the show for more than 10 years, you need to own more property or get started with your first property. Now, I've already given you one great resource for that. And yes, what do they say? The turtle never got ahead until he stuck his neck out. Now, the uncertainty, that's just that condition that never completely abates. But in a sense, I think you can say today that the future is already here because we've got substantially more economic certainty and political certainty than we have had in recent years. The presidency was decided peacefully. Recession fears have abated. The Fed, after screwing up with high inflation a few years ago, they have now engineered a soft landing, meaning lower inflation with still high employment. So now is a good time. What about real estate prices? I'll tell you something about that. All of my investor life, every single property that I've ever bought, without exception, it felt aggressively priced at the time. And then typically it always happens when as little as 1 year or 2 years goes by, it already looked like a good decision. And I'd like to encourage you to do something else in this era. If you can swing it, buy new build property. That's something that wasn't always true. They do cost more. It's probably going to be $300K plus for a new build rental single family home. But either way, be sure to own more property, existing or new. Benefit from what we talk about. Now, in some parts of the nation, including Florida, builders built a few too many properties, and they are willing to give you a discount for that. They might even cut the price a little and give you a rate discount, buying down discount points for you, so that you can get a mortgage loan interest rate in the 5s or even in the 4s on new build income property right now. In a volatile insurance market, new builds also have some super low insurance premiums because the property is built to today's more stringent codes. I mean, let's just put an example out here. If you, say, buy 10 rental single-family homes for $3 million total, 10 properties at $300K each. Okay, at just 5% appreciation, which is what I projected for this year in our home price appreciation forecast 2 weeks ago, on $3 million worth of property, that's $150K per year, every year, growing, that you can pull out of the properties completely tax-free. But to get that $150K per year tax-free, you would have only had to make a $750K down payment and closing costs, 25% on this. That's not even counting the cash flow that the properties generate, plus your loan, of course, is simultaneously being paid down by tenants. And on top of that, inflation would just relentlessly debase your $2.25 million of fixed rate debt. Yes, all while the appreciation and the cash flow occurs, inflation debases your debt by another $67,500 every single year, and your tenant pays down some more principal on top of that. And then there are the other tax benefits too, and this is where you are massively getting ahead. All right, that was a $3 million portfolio. But if you can only do 1/10 of that, own just say one more new build 300K single family rental, then you get 1/10 of those benefits that I mentioned. And either way, a total return on investment of 30% or more annually, that is achievable. It's actually even conservative. I mean, just with the 5% appreciation, with 4-to-1 leverage, that's a 20% return just on the appreciation component alone. And our GRE investment coaches can make this real for you. They can talk to you about these properties and others, including those mortgage rate buydowns into the 5s and the 4s. Properties in investor advantage markets in Ohio, Indiana, Illinois, Pennsylvania, Georgia, Oklahoma, Texas, Florida, Alabama, Mississippi, Tennessee, Arkansas, and some others. In fact, let me give you 2 examples of what our investment coaches can help you with right now. This is pretty fun, actually, as I talk about these properties, because you might even end up owning the ones that I discuss right here on the show. The first of 2 is a brand new build single family in Palm Coast, Florida. It's a ranch home, really good looking. 2-car garage is what I'm looking at here. It's 1,200 square feet, 3-bed, 2-bath. It's called the Bing model, and it's got the type of layout that tenants really want today. I mean, your resident could stay there for a long time. $2,100 in rent for a purchase price of $289,900. I mean, those numbers, along with the mortgage rate buydown to 4.5%, plus new build insurance premiums that are going to be low, that really works today. That is really attractive there in Palm Coast, Florida. And the last one I'll mention is an older single-family rental in Canton, Ohio. Yes, that's the home of the Pro Football Hall of Fame. The address is 2422 6th Street Northwest in Canton. Rent of $1,225 and a purchase price of just $135,000. The size is 1,036 square feet, and it is 4 beds, 1.5 baths. The renovations really look quite good. As you recall those benefits of buying property that's already renovated, like I discussed earlier, all for $135K in today's market. So these properties and so many more like them, that's what our investment coaches can help you with. Their service is always completely free, But first, what they do is they learn a little about you, and they can then put together an entire investment real estate portfolio for you if you like. So they'll assess and evaluate what you've got, where you want to go, what property types are conducive to aligning with your strategy, and are there any best geographies for you, and more. So it's really important to stay in touch with your coach. I mean, we might find out, for example, tomorrow that a home builder that we work with decided to offer some massive mortgage rate buy-down incentives for you because, say, they built too much. So I really encourage you to set up that touch point for the first time or to stay in touch and see what's happening. Free coaching, off-market opportunities, and it's easy to set up a short meeting over the phone or on Zoom with an investment coach. You can do that at GRE Marketplace. It really can be quite a life-changing venture for you from gremarketplace.com. Just click on the coaching area. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.